At our strategy, we look at markets through phases, not headlines. We focus on sequencing, fragility, and liquidity conditions. This Japan story matters because it touches all three. Japan did not just see yields move, it showed what happens when buyers step away. And when that happens, small moves can turn into big signals. This comes from a deep discussion on Japan, China, gold, and liquidity. The key insight was not panic, but plumbing. Specifically, how little selling it took to move the market. Long Japanese bonds moved sharply on very thin trading. That tells us liquidity was already fragile. Prices moved because depth was missing, not because fundamentals changed overnight. This is happening because the central bank owns most of the bond market, and when that happens, real buyers slowly disappear. When selling finally shows up, prices gap instead of adjusting smoothly. This is not just a Japan story. It shows what happens when markets are engineered for stability too long. Volatility becomes the signal when liquidity breaks. The first stress shows up in levered duration and carry exposure. Then it spreads to anything that assumes stable long rates. This is how localized stress can start to travel. Japan faces a hard choice between supporting bonds or supporting the currency. Either choice creates pressure somewhere else. That is how regional stress can become global. A weaker yen increases competitive pressure on China. That adds deflation risk inside an already fragile system. This is one reason gold demand rises as optionality. This is happening because local assets feel risky in uncertain systems, and when that happens, people move toward assets that travel well. Gold fits that role for many participants. The discussion also touched on AI and debt-funded growth. Transformational technology can still be mispriced. Higher capital costs eventually force discipline. If this way of breaking down market signals is useful, subscribing just helps you stay connected to how we think about risk and liquidity, especially when headlines start to get noisy. Quick note before we continue. This is educational macro analysis, not financial advice. We focus on process and probabilities, not predictions. Japan moves higher on our liquidity risk watch list. Thin markets increase the chance of nonlinear moves. That changes how we think about timing when other signals confirm. One event does not equal a full crisis. We still wait for confirmation across credit and funding stress. Patience remains part of risk management. This environment aligns more with Phase 2 behavior. Durability, balance sheets, and optionality matter more than upside stories. That usually shows up before fundamentals visibly weaken. Liquidity failures often appear quietly before they appear loudly. Japan just offered a clean example. It reminds us what actually moves markets under stress. This is not about fear. It is about understanding how systems behave when depth disappears. That awareness is what lets us adapt instead of react.